Uh, Great, thank you very much, everybody. So I'm just going to talk about the Polar Capital Global Financials Trust. Very quickly, a little bit about the team. There's 6 of us now, 120 plus years of experience. So a lot of resource going in. We have a number of funds that we're looking at the space, just to give you a sense of some of the expertise there. We run 3 strategies. I jokingly call them skimmed, semi-skimmed and full fat. So on the left-hand side, you've got a credit fund. In the middle, I'm going to talk about the trust today. It's an income and growth vehicle. And finally, a more growth-orientated version of the global financial space. So the trust, which I'll touch on, launched about 10 years ago, really is a play on the recovery of financials. Yield of around 3%, which has grown about mid-single digits per annum over that period. Fundamentally, it's an equity fund. We've got a little bit of fixed income in there as a yield kicker, so I can touch on that a bit later. But very much, we're trying to give you this broad exposure to global financials. Second largest sector globally after technology. It gives you exposure to banks, insurance, diversified financials, and latterly, as of last year, fintech. So the likes of payment companies, MasterCard, Visa have come into our universe as well, even though we've invested in it prior to that. That mix of banks, from a very large JP Morgan hitting all-time highs in the last couple of days, down to something like OSB, One Savings Bank in the UK, a little bit more specialist, a little bit more niche, insurance companies, P&C, motor finance, reinsurance, and so forth, and you've got some alternative asset managers in there. It is a fascinating sector. It has provided fantastic returns and fantastic disappointment. The reason we like it is you're able to access really great businesses at what we think are, fair prices, and some, what you'd probably argue, average businesses at fantastically cheap prices. I'll let you decide which those are. So performance, obviously, that's important to everyone here. So how have we done and how's the sector done over that period? So since inception, the trust and the sector's compounded about 8.5% per annum. So take that on its own, and actually that's a pretty attractive return for equities. Obviously, put it aside technology, and it's a very much different case. But we say, for what the sector has gone through over the last 10 years with regulation, capital requirements, fines, and low and negative interest rates, you've actually still eked out a decent return over that period. We had a corporate action back in 2020. From that date, then you're looking at much better returns than the wider market. And that's the reason the sector's benefited from, obviously, the recovery from the pandemic, higher interest rates. That means banks make more money as margins have expanded, and the sector's seen a little bit of re-rating over that period. How have we done against the peer group? In answer to, obviously, some of the questions earlier. We've beaten the sort of open-ended peer group. The trust is unique. It's the only financials trust out there. So either we're number one or we're last, depending on how you look at that. The other thing I like to highlight is don't look at the sector through the lens of what's happened with UK banks. UK bank performance at the bottom, over 10 years, they've delivered 10%. The global financials have delivered over 130%. Obviously news last week with Virgin Money buying Nationwide, going for an incredibly low valuation, gone for a record there, but gone for a song. Obviously there's a connection there, but we can touch on that perhaps in Q&A. Obviously for compliance reasons, shows discrete performance. So some of the themes we're seeing at the moment, we pick up on some of these. Alternative asset managers, you'll have heard of the likes of Blackstone, Apollo, and KKR. We see that as a really interesting area at the moment. Why is it different to some of the traditional asset managers like ourselves or some of the other speakers here? A lot of that capital is locked up, either for 5+ years or permanent. It's very difficult to get it away, so that makes it a much more attractive model for owners of these businesses. Reinsurance, hard market. It's a very cyclical market. Again, you've probably seen with your motor insurance, premiums have gone up a lot. Reinsurers have also been benefiting from that, so I'll touch on that in a couple of slides later. Emerging markets, growth and reform, again, going back to the previous speaker, it depends which market you look at. If you look at the likes of Indonesia, really fast-growing markets, financial services underpenetrated in those. Equally, there's much slower, markets out there which offer opportunity. A lot of interesting, smaller mid-cap companies. Seen obviously with what's happened with Virgin Money, Direct Line, Wincanton, etc. That in the UK there's a lot of cheap companies that are, there for a song or for strategic buyers to come in. So we see some opportunities there, and of course banks, which is an important part of the sector, and we'll touch on that. So why do we like alternative asset managers? Ultimately, it's a combination of one, regulation for companies that are listed on markets, the requirement for longer annual reports, for listing requirements. You've seen that cost of listing going up, and yet obviously the advantage of being unlisted, being private, is huge. You might have only 1 or 2 shareholders. You don't have 100 plus to keep happy. You can change management teams very quickly. The capital's locked up for many, many years. And actually, when you look at the underlying returns and the funds that these private managers have produced, I mean, they're excellent, notwithstanding that some of that's driven by leverage. So we continue to like this space. It's a benefit of a soft landing if we see one, obviously an improvement in the outlook, as some of these companies, some of these funds start to sell some of their best assets, and you start to see the flywheel of capital start to be released, and that comes through on performance. Reinsurance. So it's a very commoditized, it's a very cyclical market. So we're thinking of things like the Lloyd's companies here, Munich Re, some of the Bermuda reinsurers. If you go back pre the pandemic, a lot of the reinsurance companies weren't making their cost of capital. The reasons for that is obviously to do with increased frequency of claims, whether that's climate change or whatever, and increased costs of claims. So obviously more building in flood zones and so forth, more hurricanes. And consequently, you've seen reinsurance rates rise quite markedly over the last 5 years. What happened last year was reinsurers got fed up with what they call secondary perils. So this is floods, this is hailstorms, etc. They're effectively paying for the claims of what you call primary insurers, your Direct Line, your Aviva, and so forth. So they put up what you call attachment points. So a bit like your excess on your car insurance policy. Reinsurers said, we're no longer happy with that. We're not going to pay out on a loss, an earthquake, a flood, unless the claim is much, much bigger. So consequently, that with much increased reinsurance rates, which went up by about 35% last year, suddenly reinsurance companies are making much, much more money. And you're seeing, again, some of these companies hitting all-time highs. So we find that's an attractive area. The other attraction is, again, similar to banks. The other way that insurance companies make money is they invest that float. When you pay your premium, they put it in fixed income. If you're Berkshire Hathaway, you put it in equities as well. And with the yields increasing, we've seen in the last couple of years, insurance companies that make more money on their investment income. So you've seen the profitability of these companies improve markedly in the last couple of years. Emerging markets. As we touched on, key reason we like countries like India and Indonesia. Financial services penetration is very, very low. So you see this long structural growth tailwind as people start taking mortgages out, and as that grows, with booming middle class, etc., and access to financial services. A little bit the other end of the spectrum, reform. Japanese financials have performed very well in the last couple of years, partly obviously on expectation of a normalization of interest rates, but also on reform. We're seeing this in Korea as well. So when we worry about UK financials, UK equities looking very cheap, when you look at some of the Korean banks, they're trading at sort of 0.3, 0.35 times price to book. So it makes UK banks look expensive. So we've seen some interesting opportunities there. Capital return, a lot of these banks are now returning. They've rebuilt their balance sheets after the GFC, forced to by regulation. So their capital ratios are much stronger. They're not growing as fast as they were pre-GFC. So consequently, they have this excess capital. So they're returning a lot more of that now to shareholders. through buybacks and dividends. So US banks on the left, it's more through buybacks, and on the right, the European banks have been getting in on the act. Buybacks, dividends, the amount of capital that's being returned by some of these banks is just quite extraordinary. Commercial real estate. Can't escape talking a little bit about that. It's been in the news. New York Community Bank, Azora Bank, a Japanese bank, Deutsche Pfandbrief in Germany. There's obviously worries with the change in working patterns, working from home, the value of some of these office properties are worth materially less. So anecdotal stories of office properties in New York being sold for 85% less than what they were bought 5+ years previously. So that's been a concern, and banks' exposure to that. Now the difference here is most banks, even where we're showing on the right-hand side, some of these US regional banks have a lot of exposure to commercial real estate. Their exposure to office is very, very small. And banks have actually reserved materially for this issue. Now, we're a bit cautious on them at the moment. We think this problem isn't going away. It's a headwind for the sector. But banks are already assuming that 1 in 5 of their borrowers will default and they'll lose 50% on every single loan. So there's some quite conservative provisions put aside. Latterly, before sort of winding up the last couple of slides, opportunity in bonds are issued by banks and insurers. When you go back a few years, as you all appreciate, it's very difficult to get any yield in the bond market. Today that's changed. You can buy senior or subordinated bank bonds, insurance bonds, yielding high single digit. If you want to take a little bit more risk, you can get double digit. Be careful what you wish for. But the difference today is banks, insurers have more capital, they're more profitable. The mic drop moment is despite the GFC, despite the savings and loans crisis, despite the US regional bank crisis last year, financials on average default half the time non-financials do. So if you can buy something that yields the same or more, all things being equal, you actually get an attractive risk reward. Just quickly on valuations, it is the hook. It's always the hook why the sector is so attractive. Probably the largest constituent of value indices. Today, if you buy a portfolio of global banks, does that work? Oh, it does. You pay 8.6 times 2025. What we've done here is we've taken the number of days since the global financial crisis that banks and insurers have traded at or below these levels. So if a bank's at 8.6 times, you've only been able to buy them 1 day in 5 at a cheaper level over the last 15 years. The reason for the red is the trust is trading on about a 10% discount. So therefore, on a look-through basis, you're buying banks at 7.8 times, so it's less than 1 day in 10 that you've been able to buy banks at as cheap as this. Insurance, it's a defensive, counter-cyclical sector. It's more reassuringly expensive. It's not as cheap, but it's equally not as expensive. Finally, on the portfolio, so really reflecting that broad exposure, big holdings in companies you'll know well, I've heard of JP Morgan, MasterCard, Visa, and so forth, Berkshire Hathaway in there, and some less well-known, which disappear off the end of the portfolio. It's very much giving that broad exposure to global financials. US represents just under 50%. And the opportunity, all things being equal, is the trust is on a 10% discount today. When the trust was reconstructed back in 2020, it moved from a fixed life to an indefinite life subject to regular 5-yearly tenders. The next one is in June next year, whereas 100% tender offer at NAV less costs. So if you can buy at a discount, you can sell out at the NAV or thereabouts in just over a year's time. I can't tell you what the NAV will be in a year's time, but that certainly gives you, a catalyst for seeing that discount to rate narrow. So just to wrap up, very well experienced resource team. We've been doing this for a long time. It's a huge sector. There's a lot we can capitalize on. And there's a high conviction portfolio of some of our best ideas. And with that, thank you for your interest. I'm very happy to take questions.
Thank you very much. Thank you.
Thank you.
Super. Okay, we've got questions straight away at the back there, please, Chris.
Sorry.
Yeah.
Yes, I wanted to ask a pessimistic question as to what safeguards do your trust have in place in case there's another global financial crisis?
What safeguards do we have? If there's another global financial crisis, I wouldn't buy this if I were you. But I think the big difference, what's changed since the GFC? Banks have materially more capital than they did before. They have vastly more liquidity. Northern Rock ran out of money within 2 weeks, and had to go to the Bank of England. A lot of the risk has shifted off balance sheets to alternative asset managers, hedge funds, and so forth. So they're taking a lot less risk, and they're making more money. So you can never say never, but the ingredients that were there in the run-up to the GFC aren't there today. And I suppose the best example is we've had Credit Suisse effectively fail and be sold to UBS. We've had a couple of, 3, 4 banks in the US fail, and that was resolved, pretty quickly and with limited impact on the wider banking sector. But nothing's risk-free.
Other questions, please? Thank you. Steve?
Yeah, you mentioned Japan, and you were looking at both the yield control policy and also the improvements in corporate governance. I noticed Japan is relatively small in the portfolio, but there's obviously increasing speculation either next week or next month that yield control goes.
Yes.
And assuming, let's say, short rates go up to positive and the 10-year bonds, let's pick a figure, goes up to 1%, say.
Yeah.
What would be there's lots of effects coming in here, what would be the effects on banks, insurance companies, or your Japanese exposure? And would there be any wider effects, do you think, if, for instance, people were big sellers of Japanese 10-year bonds and putting it somewhere else?
Yes, to all of that. Yes, the fascinating thing with Japanese financials, in a sense, they've anticipated this. They've performed very well over the last couple of years in anticipation of higher rates. So when you look at European banks today, you've seen their earnings have gone up significantly on the back of the ECB raising rates, and they've continued to go up as they make more money. That hasn't happened for, only to a very small extent. So to the extent rates, which we expect they will go up, it will have an impact. Numbers off the top of my head, I can't think, but maybe it's low double digit or something. Now the question is, you could argue that's already in the price. Does this mean that the Bank of Japan will then move further at some point and come to a more normalized interest rate, 50 basis points, not 10 or something? And if they do, that's materially higher impact on their earnings. So that's what people are playing. What impact it has on the yen? The yen's been very weak. You could argue it will start to strengthen. People have borrowed a lot in the yen. That could have ramifications. So there's a lot of moving parts in there. So we think it's an interesting story. The size of our, might say, we're not betting the bank on it.
Other questions for Nick? I had one. You have no UK banks at all? Or do you have any lower down?
So the two we have one savings bank, what's called OSB Group. Even though we thankfully didn't own it at the time. Despite it derating in recent years, it's still compounded at something like 15% per annum since the IPO back in 2014, 2015. So we've liked that. We have bought a position in Barclays. They're just incredibly cheap. The earnings yield on some of these banks is double digit. So you've got to, if you can sit there, even if it is trading at 0.4 times book and a 5 or 6 times PE, in theory you could generate a decent return, without the bank necessarily delivering better numbers.
And the other question I had is around dividends. There's two parts. The first, you said a lot of buybacks, a lot of dividends in Europe. Do you have a preference one over the other? And has that increased the yield on the trust? Do you pay a dividend? And what is that? Yeah,
so the dividend on the trust is about 2.9% at the moment. If you're trading at a big discount to book, I'd prefer. We obviously want income, but at the same time, you're mad to increase your dividend payout ratio when you can buy back your shares so cheaply. You want to see companies return their capital. It's hugely accretive at some of the valuations you're seeing. So.
Other questions in the room? Gentleman over here, please. Steve, thank you.
Yeah.
Could pass that along, thanks.
I wanted to ask how concentrated you are relative to your index, because it seemed to be fairly similar performance over that period you displayed earlier.
So we have an active share, if that means anything to anyone in the room, of about 72%. So that does suggest actually there's quite some large differences. The portfolio, there's a core portfolio of 50, 55 names, and there's a bit of a tail. We've got some fixed income there, quite a few small holdings that don't necessarily have an impact. So it's something we're looking to increase, sort of differentiate the trust a little bit more than it has been historically. But I think when we launched it, it was back in 2013, people had been through a lot owning bank shares. And so we wanted to give something that was giving you that broad and low-risk way of playing financials without necessarily taking huge bets. We've seen people blow up doing that. That helps.
I had another one about private companies. Do you have any private company exposure? And is that something you could do if you wanted to?
Yeah, so the trust structure, we have some gearing at the moment. It's about just under 6%. The other one is we have 2 unquoted. Moneybox, which is a UK sort of ISA savings platform, and Atom Bank, which is a digital bank. Both are quite small. They add up to about 1% of the trust. So we're excited by both, but yeah, they won't move the dial.
And then looking at Monzo's, Klarna's, some of the spoken about future IPOs. You don't have any of those at the moment?
No, we don't.
Any other questions, please, Nick? Okay, thank you.
A very interesting talk, thank you. 2 questions. The first one is there are companies like Aviva that have been on the radar as being potential takeovers, and they've got a lot of cash generating capability. I don't know if you actually include that within the trust. And secondly, the big problem I see that is going to affect the world, whether we like it or not, is the housing problem in China. I'm not exactly how to describe it, but there is one where there's sort of problems, and that'll hit finances. What precautions have you taken to protect yourself against that when it does hit, like a tsunami?
Yes, thank you. So we've never owned any Chinese state banks. They manage risk with a member of the CCCP, sort of sat in the risk department. That tells you all you need to know. We do have exposure to Hong Kong Exchange as a sort of potential recovery play when they try and stimulate the economy. But yeah, it's concerns. I think the Chinese financial system is very closed, so they can delay the problems for a long time. This is not new. I mean, people have written books about it 10 years ago. But they can resolve it, but it probably means much lower growth. There's a risk. We've obviously seen deflation coming out of China even as we speak today. And that has ramifications for inflation globally. Obviously, there's a whole geopolitics as a separate story. We don't have any exposure to Taiwan in the trust. So, if and when an event happened, it will have huge ramifications, and that's bad for equity markets wherever you look.
So how do you protect yourself against it?
Well, our protection is to have with the exception of Hong Kong Exchange, no exposure. But otherwise, you're seeing some of the share prices hit all-time highs at the moment, as you are with the broader market. So that tells you that the market is missing something, is perhaps being not aware of obviously risks underlying. But if that changes, then we'll respond.
And that
We
Aviva?
don't own Aviva.
Well, why not? Sorry, thanks.
No, why not? I mean, if you look at, I suppose, as a long-term chart, we've looked. Aviva's not been. It's a combination of a lot of businesses that have been sort of slammed together, from financial synergies, which have never really made sense strategically, and until recently, where they've obviously been selling down and retaining capital. That's the only time they've performed well in the last 20 years. So, it's a case that we can find much better things elsewhere. Yeah, thanks.
I have one final one then, Nick, and it's around M&A in the portfolio. Have you seen much of an increasing amount of M&A in the portfolio in the last couple of years?
Surprisingly limited. I mean, until the last few months, where you've seen it pick up with the likes of Direct Line and Virgin. We own some Gresham House, which is an asset manager that was taken private. I think that was back in the middle of last summer. But it's been relatively limited. What they call bid offer between asking prices, or sellers want and willing buyers are willing to pay. There's been much less than we thought there would be. And now that's starting to pick up, and we think that will pick up.
Okay. Nick, thank you very much indeed for joining us. Thank you.
Great. Thank you very much.